Hey guys, Toby Mathis here, and today we're going to go over why you cannot time the real estate market, but what you can do instead. I'll just call it, you can't time the market, but you can do this. So we're going to jump right on in. Now, first off, just a little tax lawyer, right? I invest in hundreds of properties, and I like to look at numbers. So every time I hear things on the news, it starts talking at me and says, we're going to go to a crash, we're all this fearful stuff. I perk up and I go, oh, they're doing something very emotional. Let's see if the numbers back it up. So some of you guys might remember pre-2008, we had this huge market just drop off. You might remember leading up to that. You know, there's people like, oh, we couldn't go into a recession. Oh, real estate's going to go up forever. All those things. But what we knew, or what we now know, I guess we should have known it then, and I didn't have a crystal ball. But what you saw was that the value of the houses that were being purchased was far outpacing the rents. So I kind of do this factor. I just do it as a kind of a percentage. What you do is you look at the price index of homes versus rents of that, or the rental value of that same property. So I'll use it like this. Let's say you had $1 million house and you could rent it for $3,000 a month. You know, so you're like, okay, I can bring in $36,000 a year. Cut that in half because you're going to have expenses and everything else that's going to knock that thing down. That just tells you how much you're going to make. So what is that? $1 million house, and you're going to make $18,000. That's about a 1.8 cap. Any investor would look at that and go, that is absolute garbage. I would not touch that. What would be something that you might get an investor to go for? I could tell you right off the top of my head, 18,000 would probably be about $300,000 would get you about a 6 cap, because you take the fair market value and you divide it by the cap rate. So, or in some cases, yeah, that's what I would just do on that one. I would say, hey, let's take a look at the NOI divided by the cap rate will get you kind of its fair market value. So its NOI is its net operating income. So here, I'll just run this through real quick. A lot of people are used to all the equations. So if I say cap, what that means is the capitalization rate. If you're already a real estate investor, just close your ears. You don't care about this. But all it is a calculation of saying the net operating income divided by the fair market value. But if you want to get the fair market value, you just change it to fair market value is equal to NOI divided by cap. And let me go over what these are, just in case you're new, just to make sure that we're also on the same page. And even if you're experienced, sometimes this stuff, it always gets me a little crazy, right? So if my cap rate is what my return is. My net operating income is my income minus expense. And in real estate, we do things like calculate the vacancy rate, even though we're getting paid. We calculate repairs that we're going to have to make, even though we're getting paid. And we come up with this funky little NOI. So some people like to have a larger NOI as a percentage. So for example, if I bring in $36,000 a year on a property, they may say my NOI is $30,000, like some really high percentage. Conservative people like me cut that number in half and say, you know what, I don't even want to mess with it. Or they'll use a gross rent multiplier. And they'll just be like, you know what, I don't even want to monkey around with what's the net. I'm just going to go off of gross numbers. I just cut them in half. I'm one of those guys that says, hey, you know what, I feel really good about giving myself a kind of a worst case scenario. And having done this for 25 years and having hundreds of properties, I could pretty much say it's pretty good. 50% is very, very conservative. You're probably going to be coming in at 65, meaning that you're going to net 65% of your gross rents. So if you make $10,000 gross rent, you'll probably keep $6,500 of it. But I like using my calculations at 50% because it keeps me from being too crazy. Plus, it puts some money in the kitty. I'd rather do that. So then you can say, hey, my cap rate is whatever that number is divided by the fair market value. So if I have $18,000 a year coming in as my net operating income divided by 1 million, that's where I can get to my 1.8 cap. Like, whoops, didn't do so great. Nuts. That's not a good investment, right? But I can calculate reverse by saying, hey, my NOI, 18,000, and I can divide it by the cap rate, 6%, and I could get to, that's going to be about $300,000. Why do I say this? Why do I bring up this stuff? Because guess what Vegas went right to? That house that was the $1 million, guess what it sold for? Close to 300. They lost 75% of their values on average. That was just the foreclosures. Then there was the short sales, the regular sales, and everything else. What happened was the market could not sustain itself for typical new purchasers. And so the investors came in and bought it up. And that's what I'm pointing out, is that right now we have a system where the market is definitely ballooning. Absolutely positive. But you know what else is? Rents. This is not the same scenario. I could distinguish 2007 and 8 for right now on a number of situations. Number one, the foreclosures. They're actually down. Year over year, they were down like 40-some%. Black Knight puts out all these reports. You just have you defeat the narrative, right? Oh, it's all going to blow up. It's going to be 2007 and 8 again. Fine. You guys want to have fear? Great. Because everybody who's an investor is perking up going, cool. Maybe they'll get reasonable in some of their prices. Other thing, the typical finance, not only are foreclosures way down, but defaults are way down, close to like really, really historic lows. You'll see percentages bandied about like, oh, foreclosure or late mortgages are up 100%. Well, it was like 1. Now it's 2, right? I'm not saying there's only one person behind, but it's a really low percentage total. And the average credit score is about 100 higher. 3, we had adjustable rate mortgage diarrhea in 2008. What I mean is that we had so many of these liar loans that are adjustable rate and these low introductory interest only rates or even below interest negative AM loans. And then boom, you had to pay it, and your payment literally jumped about 30-40%, in some cases more. And you're like, wait a second, same house. All that changed was time, and this is not a good time for me to have this real estate. 4, we were overbuilt at that period of time. In other words, we had excess inventory. How do we know? Because tons of real estate sat on the market. You had like a 6-month supply. What type of supply do we have now? Here's a hint. Really, really low. We do not have enough housing in the United States for our current inhabitants. We're probably 3 million units behind, depending on who you want to listen to. And guess what just happened? Housing starts went down, but that's only for single family. Housing starts for multifamily went up. Why? People are realizing excess demand. You can raise the interest rates all you want. It's not going to affect the person who's calculating their numbers this way, right? They're just looking at it saying, here's my cost and not money. Sometimes it's just liquid. They're going in all cash, or it's investors pooling their money in a syndication or whatnot. And they're just looking at it going, how do I pencil it? What is it worth to me? So the comp is what the realtors are using and what people are using when they're buying a house. And I don't begrudge it. Yep. Hey, I want to live in that neighborhood, in that school district, everything else. I want to live there. I will pay whatever it costs to get in there. That might be the $1 million. But a investor does not care where the house is or the apartment is or whatever it is. They're looking at it saying, what type of return can I get on my money? So that's always going to be your bailout. And right now, they're keeping pace a little bit. We're seeing it get a little inflated, but we're not yet to the level it was in 2007. That does not mean that there won't be a cooling off of the market. Figure that the market is a big old jumbo jet. It's taken off, and it just did if you've ever been down to Orange County, like the John Wayne Airport, they just take off almost like straight up because they have these issues with the local communities and the noise. So they have to just really go straight up, right? So you just went, and now you're leveling out. Doesn't mean the plane's going to crash. It means it's leveling out. You might cruise. Could you drop a little bit, go up a little bit? They're saying it's going to keep going up. And when I say the consensus of the real estate markets is that we're still going to have increases year over year in home prices in 2022 and 2023. But if you turn on your TV, it's the market's about to crash. Austin's on fire. It's going to blow up. It's going to completely pop. What is it? Tampa went up. That was one of the top markets. Raleigh was like number 2 last year. All these places, they're going to pop. No, they're not going to pop. They might slow down because affordability became an issue because they're jacking up interest rates. You know who doesn't care about that? This guy. There's always a value. And guess what there's a shortage of? Houses. There's always going to be a value to the investor. And it's not that far off. I'm using the 2007 number, right, of $1 million for 3,000. That's not the 2022 number, right? That $1 million unit is going to fetch a lot more. Might be close to whatever, close to $100,000 a year. Cut that in half, 50,000 you make, and you actually have a decent cap rate. So yeah, somebody might actually buy that. Say, the rents are so high. Just remember what kind of happens in the markets. Like there's this hype, and I'll use an example of, I was down in San Francisco a few years back, a long time ago, actually, probably about 10 years ago. And I'm walking through the neighborhood, and somebody is showing me an apartment that they had just sold. It was on the first floor, street level. I literally stepped over another human being. Somebody was sleeping in front of it. They said, don't disturb them. Step over them to get into the unit. It was 700 square feet, ground floor. You're looking right out into some things that you probably shouldn't be seeing. Right? It was a kind of a rough area. $1,000 per square foot. And I was like, who would pay $700,000 for this thing? Like 1 bedroom, 1 bath, basically a box in an area where you got to worry about homeless people right outside your door, and some whatever accompanies all that stuff. You would be, crawling over yourself to get that now. An investor's going to look at that and go, what? Like, that's not going to make me any money unless somebody's really willing to pay a lot of rent. Maybe they were paying something. I don't know whether it would pencil. But what I do know is that the desirability of that neighborhood doesn't have a huge amount to it. It's the demand to be in that neighborhood that has more to do with it. In other words, it's not the nicest 1 bedroom, 1 bath on the planet, not even in the state, but it might possibly be the highest per square foot unit around. Now it's much higher, but back then that was like shocking to get over $1,000 a foot. I know it's pretty commonplace nowadays, but again, go back 10, 15 years, whatever it was. And I just say, like, again, this would be like going into a unit that's $5,000 a foot. You'd say, like, wait, that same place being 3.5 million. It might be, right? That market is an irrational market. You are paying to be close to whatever it is you want to be close to. You are not investing there because it's giving you a return on your money. So when you see this thing get driven up and the emotional market is shooting up and the investor market is behind it, like way behind it, like one's going way up. Let's just say like this would be like 2007. There's the market and here's the rentals. And eventually this gap gets so huge that the rentals will never support, the investors will never support that income or that valuation. We are not doing that right now. We are doing more of along like this. The market's going up 20, 30%. Rents are going up 10 to 15%. It's that type of thing. They're out of balance, but they're not so out of balance that you're going to see a massive correction. You might see it fall down a little bit, and you might see certain types of properties, like the luxury properties, were massive in 2021. Could there be a little haircut there? Yeah, but we're not getting too crazy. A lot of those folks are doing cash anyway. They don't care about the financing because there was so much liquidity. Because hint, hint, the Fed took $7 trillion and dumped it into the market over the last few years. So what do you have a lot of? Cash. What do we have a lot of in our market, by the way? Like I could say another difference from back then, 2007 and 8, where a lot of people were underwater in their house. The average equity in homes right now is over 200,000. Last year it was 180,000, and depending on who you look at, it could be a 211,000. It could be even higher. Average equity in a house. In other words, they're not underwater. You're not walking away from $200,000 of equity in your house. Even if that house price drops, like again, average home is 400 some thousand. You'd have to lose half of its value before you're considering walking away. Home prices go down 10%, nobody's batting an eye. It's not, nope, I'm not going to let you foreclose. I'm going to fight this thing tooth and nail. There's investors that'll pick it up. You're just not going to see the same scenario. Almost an impossibility. That said, I don't have the crystal ball. Could there be something else that happens? Could we have civil unrest? Yes. Could there be a war? Yes. There could be things that are completely outrageous that could occur, but barring anything extraordinary like that, which you can't factor in anyway, we're going to have a fine scenario. There's going to be plenty of opportunities because you have all this emotion, and now you can get your pencils out and come out there and look at what is available and say, wait a second, this was not penciling out before, but now that rents are this high, there's this much demand, there's not enough supply. 1 bedroom, 1 bath in Las Vegas was about $1,300 last year. $1,300 a month. 1 bedroom, 1 bath. Average in the city. And people were lining up. 20 apps would go in per property. Is it that bad right now? Don't think so, but it's not that far off. You could say whatever you want about affordability on mortgages. That does not stop the demand from occurring. The people are here. They need things to live in. There's going to be continued demand. So it really comes down to it. So what you look at is, all right, if I'm an investor, I'm looking at the neighborhoods, I'm looking at the crime rates, I'm looking at the things I normally look at. I'm looking for the demand. I'm looking for that rental demand. I'm trying to figure out, all right, what is the rental market today? Calculate what I'm looking at for a return. Am I okay with a 4 cap? Am I looking for an 8? What type of return am I going to require to invest? And I can calculate in any market. I can pretty much calculate, as long as I have reasonable access to data, I can calculate what the fair market value of that property is, not to other people, but to me, right? I could say, based off of what I am seeing, here's what I could get access to. The other thing I'll give you, and I see this over and over, again, if you want to go into a city and you want to use kind of rules of thumbs, I use the 50% rule of thumb. I use 50% of the gross rents to figure out my NOI, right? I also use the 5% rule on properties. Like, what are you listing these things for? And I'll say if the gross rents are 5% or less than the fair market value, it's a renter's market. They're winning. So I probably don't want to dive into that. I'll pass on that. I'll let somebody else have it. So example, $1 million house, 5% or less would be $50,000 or less. So if my rents are below $5,000 or $50,000 a year, so probably around $4,100, $4,200, I'm not touching it. Not worth it for me. And I can just do that quick, boom, quick, boom, quick, boom. If you don't want to dive into all that, and you just want to be a passive investor and you don't want to be getting your hands dirty, you might want to look at a REIT, real estate investment trust. They're vehicles that require the payout to the shareholders. It's essentially, that's all you're doing. It's basically you're buying it like a stock. Federal Realty Trust, Public Storage, a lot of these things are out there. But they've been paying out consistently for years and years and years. Federal Realty Trust, over 50 years, they've been increasing the amount of the payout to their owners. You can buy it just like a stock. So if you want to get involved in real estate, but you don't want to get involved in real estate, right? You just want to be exposed to the market. You're looking at it going, hey, I heard this great investor once, Warren Buffett, and he said, when others are fearful, be greedy. When others are greedy, be fearful. So what do you think Buffett's doing right now? He's probably looking at all the valuations on companies and saying, hey, the economy might be in turmoil. We might be in a recession. What is he going to do? He's looking at it. Are there any good deals out there? Real estate's no different, but if you don't want to get your hands dirty in it, you could certainly invest in others. You could say, hey, you know what? I want to participate in this. Or on a lesser scale, you do private placements. There's plenty of people that syndicate, which bringing together private investors. This is not publicly traded. You might be able to get access through your brokerage, and there's qualifications on most of them. You'd have to be an accredited investor, which means you make over a couple $100,000 a year, or you are worth more than $1 million outside of your house. If you're an accredited investor, you can invest in any PPM. Otherwise, they might have some restrictions on what you can invest in. But whatever the case, it's investors getting together on particular types of properties or particular deals. So, for example, I'm a member of a bunch. I use one. I do storage. Sometimes you're going and you're saying, we are buying this storage unit. We're going to modernize it. We're going to increase its revenue. And because we increase the NOI, now you're seeing how this works. If I increase the NOI 10%, price follows, pushes it up. Pushes it up, absolutely. Makes that value even more extreme to an investor. Doesn't mean that on the market you're saying, oh, that building is, boy, there's so much demand for that building. No, we're not sitting there playing the comp game. What we're playing is what's the cap rate in that area and what's the net operating income. And if we can increase the net operating income by lowering our expenses or increasing the amount that it actually rents for, which could be reducing vacancy, making sure that we're utilizing all of the units. Believe it or not, that's one of those weird things where people have storage and the owners will keep a bunch of the units for themselves, or they just don't repair them and they keep them out of the rental pool. They never raise rents, all these things, or they have on-site management and they're not automating. You do all those things, but you come in there and you, boom, you fix all that, jumps up the NOI, cap rate doesn't even have to change, your fair market value jumps through the roof, and you have double-digit, sometimes triple-digit returns just because you did that. There's still those opportunities too. You could go do that. So let's say you're a doctor, you just don't have time. Private placements are probably your friend. REITs are probably your friend. Otherwise, maybe it's something close to you. You look at your neighborhood and you start seeing, hey, people are really fearful. This might be a good opportunity. Like maybe they're pumping the brakes a little bit. It doesn't mean it's not going to stop. It's not going to fall out of the sky again. Let's use the jumbo jet. It's cruising, and it might be going up, just not as fast. It's just not. It's not doing a Tom Cruise straight up. It's just doing a nice steady eddy, or it's just kind of, might just barely be going up. Whatever the case, you look around and you start to say, hey, you know what? This is my opportunity. I know that this market, I know this area. Maybe I pick up something that's closer to me, that's in my backyard. Maybe it's even something that you're considering as hey, I want a house for a child. Maybe it's one of my kids. I kind of want them to be in my neighborhood. This might be my chance. Everybody's freaking out. Here's what that number looks. Hey, I could rent it in the meantime. Here's what that would mean. Here's how I can calculate it. Here's what my budget is. Maybe that works for you. Anyway, so you're able to go out there when you quit playing around with the timing. Like if you just put your pocketbook away because everything on TV is, this is horrible, it's going to crash, oh, we're going to have another 2008 and all that stuff. If you put your pocketbook away, you're going to miss out on a lot of opportunities. The numbers don't lie. If you start looking at numbers, and I'm specifically talking about return on your investment, if you're actually looking at it and you're walking in and you could say, hey, I'm not going to worry what the realtor says this property is worth. Hey, this house, I've had this a million times. This house is worth $200,000. Calculate it. This is what the rents would be. Here's an offer for $120,000. Oh, they'll never take that. And then they take it. Or there's something where they take it and it ends up working out. Stick to your guns. Stick to your numbers. Know your numbers, and then you can invest and still do well. Because you know who killed it during 2008, 9, and 10? Companies buying all the properties that nobody else wanted to touch. BlackRock, Blackstone, whatever. They were coming in and just buying in mass. Vegas. I lost one of my contractors to managing a bunch of theirs, and he would just feed me data all day long. Great. It was like, whoa. They were just buying anything. They were buying 20% over market. Because again, they weren't looking at the fair market value. They weren't looking at comps. They were looking at this. What do they need to make? What is it worth to them? And they were walking in saying, I don't care what the market says. I'm going to get properties and I'm going to bring home a lot of value to my investors. And guess what they did? They killed it. Those same properties, because I'm still in these neck of the woods, I still have investments. We saw some of our properties go up in value, I would say 6, 7 times, 700% returns just on the value of the property, not to mention the rents. And if that's us, that's those guys. They're doubling their money, sometimes tripling it, and they're getting better cash flow. Because what's weird is that whole ordeal, our rents just kept going up. Throughout this whole ordeal, what do you think is going to happen? Rents are just going to keep going up. And as long as they are keeping pace with the value, and there might be some little pullback here, pumping the brakes here, that as long as they are keeping pace, that means that there's demand for it, which means that there's going to be support for it as an investment. And as long as there's support for these things as investments, for real estate, which arguably is the number one asset class for investment, there's been plenty of studies, and it's always either real estate or stocks. As long as there's continued demand for it, as long as people need a place to live, as long as we're not keeping up with the housing demands of our country, there's going to be strong demand for this asset class. And as an investor, you can do very, very well in it. Hey guys, if you like this type of information, please click the like button and subscribe to my channel. I'll even give you a picture of one of my cats. There you go, as a reward. And if you have any comments, by all means, put them down below. Let me know what you like, dislike, or what you'd like to hear on. It's an educational channel. Love sharing information, love working with people, and love your feedback.